Within the Reference Guide to Regulatory Compliance on page 989, the OCC Guidance on Insurance and Annuity Sales Activities, the Office of the Comptroller of the Currency issued an advisory letter in October of 1996, AL 96-8, to provide direction to national banks in the sale of insurance and annuities. The ability of banks to sell these products was obtained through March 1996 U.S. Supreme Court decision. This decision, favorable to the banking industry, opened the door to new business for most national banks. Therefore, the OCC issued these guidelines to provide adequate consumer protection and guarantee that insurance sales were conducted with qualified personnel and in a reasonable manner. The Gramm-Leach-Bliley Act, which became effective in April of 2001, significantly changed the insurance-related requirements that had formerly been in place. This law added some advertising requirements. Where not superseded, the 1996 OCC guidance remains in effect. Anti-tying prohibitions. It is illegal to tie the availability of credit from the bank to the purchase of insurance or annuities from the bank or its affiliate. This prohibition includes national bank operating subsidiaries. A. The bank is expected to implement procedures that will eliminate coercion when offering insurance to customers, including 1 through 6. 1. Training bank employees about tying prohibitions. 2. Involving management and reviewing training, audit, and compliance programs. 3. Updating policies and procedures as needed. 4. Reviewing customer files to determine whether any extension of credit is conditioned on obtaining insurance or annuities. 5. Monitoring incentives, fees, commissions, and so forth that may encourage tying. And 6. Responding to any customer allegations of prohibited tying arrangements. B. Banks may inform customers, 1. That insurance is required to obtain a loan or that the loan is a contingent on obtaining acceptable insurance, and 2. That insurance is available from the bank and offer information. Banks must inform customers clearly and unambiguously that they need not purchase the insurance from the bank to obtain a loan. Management oversight. Bank management must ensure that the bank's insurance and annuity sales are conducted in a safe and sound manner and in accordance with applicable laws. Sound management practices include active oversight by senior management, competent personnel, internal controls, monitoring mechanisms, and banks must tailor their management program to the complexity of their operations. Banks are encouraged to use professionals with expertise in the insurance industry as the need arises. Selection of products, 1 through 7 considerations. The bank's selection should be founded on quality and customer benefits of the products available. 2. The selection should not be based on the company's commission structure. 3. The insurance company's rating should be evaluated as well as its financial strength and managerial strength. 4. The number and substance of material complaints against the company and the existence of criminal judgments against the company or its management should be considered. 5. The pricing of the products, including the premium rates compared with similar products, should be determined. 6. The company's sales support staff should be considered. 7. Any experience of other financial institutions as readily available should be taken into consideration. Part 3. Qualification and training of staff. Bank management should strive to hire and train knowledgeable, experienced, and qualified personnel. The bank should consider the following measures to reach this goal. A, B, and C. A. Clearly define responsibilities of sales personnel. B. Verify that sales personnel are licensed and in good standing with appropriate state agencies. C. Limit the involvement of non-qualified bank personnel in the sales of insurance and annuities. We have Part 4, Appropriateness and Recommendations or Sales. Bank management should communicate to sales personnel that it is important to evaluate the appropriateness of products for a particular customer. Management should emphasize the accessibility of churning accounts, for example, selling new or replacement insurance or annuity products on the basis of commissions rather than benefits to the customer. Further, I would say fair dealing and suitability. In the margin here, I've added that note. Compensation, Part 5. Management must be aware that in a commission-based compensation system common to insurance, employees must be motivated by the reward for the sale rather than the best interest of the customer. Management must make sure that sales are not driven by commissions and that employees are aware of high-pressure sales tactics and are not acceptable to the bank. Complaint system, Part 6. Management must establish a complaint system that provides for orderly process of addressing consumer or customer complaints. Advertising, Part 7. The following disclosures must be made in all insurance advertising. A, B, C, and D. A. The insurance product or annuity is not a deposit or other obligation of or guaranteed by the bank or an affiliate of the bank. B, the insurance product or annuity is not insured by the Federal Deposit Insurance Corporation or any other agency of the United States, the bank, or, if applicable, an affiliate of the bank. C, in the case of an insurance product or annuity that involves an investment risk is associated with the product, including the possible loss of value. Disclosures must clearly indicate the company underwriting the product. And D, the bank's communications with the customers must not suggest inaccurate information, misunderstanding, confusion, or misrepresentation. Steps should be taken to minimize customer confusion about the nature of the product and to clarify when the product is not guaranteed by the bank or insured by the FDIC. 8. Third-party arrangements. The bank management should carefully consider selling insurance to a third party. Agreements should be developed to govern the relationship, including the duties and responsibilities of each party, the terms under which the third party will sell on the bank's premises, compensation arrangements, and the use of bank equipment and personnel. The agreement should authorize the bank to monitor the activities of the third party as well as the products offered. It should also require the third party to indemnify the bank for damages resulting from the actions of the third party. Customer privacy, Part 9. Bank management should be sensitive to the privacy expectations of its customers and take appropriate measures to safeguard the security of its information through internal parties.